Clarity Act versus permissionless reality. Who really owns the financial rails of the internet? The Clarity Act seeks to codify federal market structure and CFTC oversight for centralized crypto intermediaries, the Grand Central Stations, providing on-ramps to open permissionless blockchain networks that no single entity, including the state, can truly own or weaponize. While it ends the SEC CFTC turf war and brings regulatory certainty to United States-based exchanges like Coinbase and Kraken, it cannot capture the decentralized rails themselves, which were purpose-built to resist hegemon control. In a world shifting toward decentralized exchanges and direct protocol access, the bill formalizes rules for the exit gates rather than the tracks, highlighting the enduring tension between institutional codification and crypto's core design for disintermediation. Section 1, Introduction. The debate surrounding the Clarity Act often begins with warnings of America losing the race in digital assets. Yet beneath that framing lies a deeper conflict. Not whether the United States can compete technically, but whether government can formalize control over financial infrastructure that was deliberately engineered to resist centralized ownership. This exposition examines that tension. Blockchain networks, Bitcoin, Ethereum, and their successors, were built as open, permissionless systems precisely so no state or corporation could weaponize them the way the United States once did with SWIFT. Centralized exchanges serve as convenient gateways atop these rails, but they do not own the tracks. The Clarity Act, now pending in the Senate after strong House passage, attempts to resolve jurisdictional chaos and provide regulatory certainty. The real question is whether such codification can ever truly own what the technology was designed to keep unownable. Section 2, the Permissionless Foundation, Blockchain's Intentional Design. At its philosophical core, blockchain is anti-fragile infrastructure. Bitcoin's white paper and Ethereum's vision rejected single points of failure and trusted third parties. These networks operate through distributed consensus, miners or validators, token holders who vote with stakes or hash power, and users who run nodes. No chief executive officer, no board, no government department can unilaterally shut them down, censor transactions, or rewrite rules without overwhelming network consensus. This design was not accidental. It responded directly to historical abuses of financial infrastructure. When the United States leveraged SWIFT to impose sanctions, it demonstrated how control over centralized rails could be weaponized against entire nations or user groups. The crypto community internalized the lesson. Build systems where no hegemon holds an exorbitant privilege to exclude participants. Control, to the extent it exists, is diffuse, held collectively by those who secure the network through economic incentives and code. Permissionlessness means anyone can participate without approval. This creates resilience, but also friction with traditional regulatory models that assume identifiable gatekeepers. Section 3, the intermediaries as Grand Central Stations. While the base layer rails remain open, most everyday activity still flows through centralized intermediaries. Coinbase, Kraken, and Binance function as Grand Central Stations. They provide fiat on-ramps, custody, deep liquidity pools, user interfaces, and compliance wrappers. They do not own the blockchain networks. They build convenient stations atop them. These platforms currently operate in a functional but fragile gray zone. They hold stacks of state money transmitter licenses, self-restrict token listings to avoid securities risk, and benefited from the dismissal of major SEC enforcement actions in early 2025. They are rugged 4x4 vehicles navigating unpaved regulatory terrain, expensive to maintain, limited in scope, yet remarkably effective for those willing to endure the bumps. Traditional finance players face the same choice. Build their own compliance stations, as JP Morgan and others are experimenting with, or integrate via application programming interfaces and wrappers. They cannot seize the underlying rails without creating a permissioned alternative that users are likely to reject. History shows permission networks struggle for adoption when trust-minimized alternatives exist. Users who remember Swift-style exclusions prefer systems where things getting real does not result in frozen access. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4. What the Clarity Act actually clarifies. The Clarity Act, also known as the Digital Asset Market Clarity Act, does not attempt to regulate the base layer networks themselves. Instead, it targets the centralized layer, the stations. Its primary contributions are structural. Jurisdictional clarity. It creates 3 buckets: digital commodities, investment contract assets, and stablecoins, which are already addressed by the Genius Act. Digital commodities include mature tokens like Bitcoin and Ethereum, whose value derives from network utility rather than centralized efforts. The Commodity Futures Trading Commission receives exclusive oversight of spot markets for digital commodities, including anti-fraud and anti-manipulation rules, while the Securities and Exchange Commission retains authority over primary offerings that resemble securities. Federal registration regime. It establishes a digital commodity exchange category with provisional licensing, allowing platforms to operate while final rules are written. This replaces the inefficient patchwork of more than 40 state licenses with a coherent nationwide framework. Token maturity pathway. A statutory test determines when a blockchain becomes sufficiently decentralized for its token to shift from Securities and Exchange Commission oversight to Commodity Futures Trading Commission oversight, providing secondary market certainty and reducing delisting fears. Importantly, the bill includes exemptions for truly non-custodial developers, validators, liquidity providers, and decentralized finance protocols. Pure permissionless activity largely falls outside intermediary registration requirements. In practice, Clarity formalizes rules for the on-ramps and exit gates without claiming ownership of the open tracks. Section 5. The shifting market reality. Decentralized exchanges, disintermediation, and institutional adaptation. Despite centralized exchange dominance, the ground is shifting. Binance still commands a large share of global spot volume, but decentralized exchanges have grown significantly, with spot decentralized exchange market share roughly doubling in recent years and perpetual futures protocols like Hyperliquid showing explosive increases in open interest and user adoption. Newer use cases: prediction markets, tokenized real-world assets on decentralized venues, and novel protocols often perform best through direct, disintermediated interfaces. Decentralized exchanges excel because they are purpose-built for the open rails. No single custodian holds funds, smart contracts enforce rules transparently, and participation requires no gatekeeper approval. For native crypto users and forward-looking capital, engaging protocols directly reduces counterparty risk and removes points of potential censorship. Institutional investors face a dilemma. Intermediated platforms offer convenience, insurance funds, reporting tools, and regulatory comfort. Yet as protocols mature, the cost of waiting for custodians and brokers to integrate new innovations grows. Early adopters who interface directly with decentralized exchanges and protocols capture upside. Institutions that remain fully dependent on intermediaries risk becoming exit liquidity. The trajectory favors disintermediation, where it delivers superior user experience and lower friction. Law may slow institutional direct access in certain jurisdictions, but it cannot repeal the underlying technological shift. Section 6. The deeper tension: codification versus capture. The Clarity Act represents the latest phase in crypto's maturation. After spontaneous emergence seen in Bitcoin and Ethereum, regulatory tolerance seen in gray zone operation, and partial institutionalization seen in spot exchange traded funds, Genius Act stablecoins, and tokenized real-world assets, comes codification. This process is slowed by America's deliberate choice to retrofit crypto into existing 1930s-era financial statutes, rather than create a clean, new framework like the European Union's Markets in Crypto Assets regulation. The result is a prolonged turf war between the Securities and Exchange Commission, which is protective of securities jurisdiction, and the Commodity Futures Trading Commission, which is seeking commodity oversight. The stakes feel existential because crypto's total addressable market could eventually dwarf traditional equities and fixed income. Critics rightly note the frustration. Private actors already built functional infrastructure while agencies debated zoning. The bill risks appearing as an attempt to claim ownership of rails that were designed to be unownable. Yet in reality, It mostly standardizes the stations, providing legal durability that benefits even the rugged operators currently navigating without it. The deeper insight is that true capture of the permissionless base layer is impossible. Code and economic incentives protect it better than any statute. What remains contestable is the user experience layer, who provides the most convenient, compliant, and competitive interface to the open networks. Section 7. Conclusion. The Clarity Act will not resolve the fundamental philosophical divide. It can end wasteful jurisdictional fights, reduce compliance costs for centralized platforms, and give United States-facing firms clearer operating rules. In doing so, it makes the Grand Central stations more robust without touching the open rails beneath them. Permissionless design ensures that no hegemon will again enjoy unchecked power to weaponize global financial infrastructure. Decentralized exchanges and direct protocol engagement will continue expanding, rewarding users who embrace disintermediation. Institutions that adapt fastest, whether by building better stations or enabling seamless on-chain access, will thrive. Those that cling to outdated intermediation models will lag. The ridiculous feeling that permeated this discussion is understandable. Private innovation already proved the roads are drivable. Yet, codification is not pointless. It manages the hybrid reality where billions in regulated capital still prefer convenient gateways. Ultimately, the rails remain open by design. The enduring winner will be the architecture that no one can own and the users who interact with it directly.